So, I mean, the situation really hasn't changed a lot from last month. We're not seeing an improvement in internals that's substantial enough to say that this correction is really over. We would need to see, the demand curve rise above its downtrend line, the supply curve fall below its downtrend line, and especially supply or demand minus supply, the spread, rise above its downtrend line. At least two of those three need to happen before we really are pretty clear that this correction is over and that it's safe for environment to start adding loans. We're not there yet. We have a lot of reasons to suspect that we will get late October to November or sometime in that time frame, some kind of a corrective low. It's really been kind of since February that we've had small caps. You can see small caps kind of peaked with Chinese stocks and foreign stocks in February to March. All right, so anyway, the small cap and mid cap participation need to improve. This is not evidence of improvement. We really need to start breaking through resistance on small caps. We need this small cap advanced decline line to be breaking above the downtrend line and above the August highs. And until we get that, we're really sort of still in a correction, still in sideways environment where it's dangerous to add long exposure. You can see this is the relative strength of small caps and the relative strength of mid caps. Both of those are playing around with a base breakout, but really need to move above these October highs to suggest that we're starting to get a turnaround in participation. Small caps and mid caps make up about 70% of stocks, so they really need to participate. And then lately we've really been seeing this situation beginning in September, where it's not just small and mid caps that are the problem, but even S&P stocks not participating. This is a percent of stocks above in the S&P above their 50-day moving average. You can see that we've been downtrending since April. We fell below 50 and kind of bounced back, but really we've been in a downtrend and we fell below 50 in sort of early September and have stayed below, gotten resistance there and come back and made new lows. We need to move above 50 and move this above this downtrend line to show that there's enough participation even by these large cap stocks in the S&P to suggest that we're in a sustainable new trend line. Then kind of the nirvana period for when we really get outperformance on our lists is when we see strong relative strength by the IBD 50. You can see we've been in a downtrend now for some time. We really need to kind of move above these highs made in September on a relative strength basis in FFTY for it to show that it's outperforming. We're likely to get a really good period for our stock list. We're not there yet, but watching for it. We've had a kind of a preliminary increase in the relative strength here. And if we can turn around and break above those levels, that'll be a much better sign that we not only are in a rally mode, but we can get really strong outperformance as we often do in new legs higher. And October, as we've said before, what the most volatile month, the month where most lows are achieved historically. So if you go back to 1956, you look and you see that virtually half of major corrective lows come in October, November, and December. And so that is something that we're going to be looking for. We think we're set up well. We've been going sideways and down since February, really in the most markets. So that's a long enough period of time that if we can get a decent correction over signal at some point ahead, usually late October or November, then that has the prospect of being a decent move. Realize it's seasonally the move between November and April. It makes up nearly 100% of the rise in the S&P. It's been rising at a 21.75% annual rate between November and April 30 since 1970. So the real seasonal period where most of the rallies occur tend to happen in that period. And when you get bottoms in this October, November, December period and good correction overs, those tend to be some of the best correction overs that we get. and something along this line where we get some kind of a base starting to form. We had NYHL divergence at recent lows. They're kind of potentially being tested here, but in some things. But if we can hold those lows and make some kind of a base and then show some strong demand response later, we can get a good rally into the late October, November period that we can potentially looking for. Okay, so we've had now 2 months of disappointments in non-farm payrolls. You can see the sort of leveling off of demand and employment in the leisure and hospitality area. That's really an impact of the Delta variant. The under 200,000 number on the non-farm payroll was really right at that level where 200,000 to 300,000. If we got below that, most Wall Street analysts were saying that would delay the Fed tapering to December from November and potentially sort of cut the rate of tapering from 25 to 50,000 to maybe 25 or even below 25,000 or 25 billion a month of tapering. So we are probably looking, our guess would be, we're looking at an early December taper that they will announce at the early November meeting, FOMC meeting November 2nd and 3rd. They'll announce a December taper that'll be something in the 15 billion to 25 billion a month rate so that they'll be able to watch things slowly. This is not so slow yet that you say, okay, the recovery is in trouble. But it is slow enough that I think the Fed's going to go very cautiously. The other thing I'd point out is the Fed did a huge amount of overnight reverse repos on September 30th. That shows that they're concerned about the rate dropping below zero. And there's still we've had this September month problems of liquidity in short-term markets. It seems to be kind of happening again. So big part of the backdrop in September in particular has been this rise in TNX, which is a 10-year Treasury yield. The rise in yields has been a really big component and problem for the market and part of the backdrop. It's one of the reasons the financials have been performing well. Really, we've had sort of two segments that have done okay in September while the rest of the market has been falling, and that's energy and financials. Financials are really rate sensitive, so it's why they've been doing okay. And then the energies have been breaking out on their own and leading that secular commodity bull market that we've been talking about. You can do TBF or TBT, which are short the Treasury bonds to exploit further rise in rates. Although we're probably getting into a point where we're going to pause or correct when we test former highs. But I think we're probably still looking at higher rates for a while. And then financials we talked about last time are something you want to have some exposure to. So one of the areas we would probably continue to hold lightly in the correction. But the areas that are getting hit, you see that as rates rise and bonds drop, so do QQQs. And so techs are a problem with higher rate environment to realize. Now, another side effect of the rise in rates has been this sharp rise in the dollar. And you can see the dollar actually bottomed a little bit ahead of rates. And as rates started to pop meaningfully, the dollar rally really took off, broke through this neckline. We were flirted above this 93.50 level and came back down. But now we've broken back above that. This is a real concern to me. I think this 94.80 level that we've talked about for a while is to break. That really changes my outlook from being one that, all right, sideways to down in the dollar or even secular down. It's a long-term trend to something different. And so a rise in the dollar, an uptrend in the dollar really is going to potentially wreak havoc on a lot of things. It's going to slow the recovery. It interferes with the mechanism that allows for Fed stimulus to be infiltrated throughout the globe. And it makes the huge amount of dollar debt outstanding in the globe more expensive and leads to potentially even credit problems. So I don't know if the central banks are going to allow this to happen or if they'll start to intervene or something. But we get follow through upside above 94.80. That's a dark cloud in the outlook as well. You want to be concerned about. You want to watch for spillover damage of that happening to other markets, including stocks. We have earnings for Q3 coming up, starting on Wednesday, really, with some of the big banks reporting first. I have been very bullish on the impact of earnings for some time. And this is the first time where I'm less positive about the bullish outcome. I think we'll still have probably a net bullish, but it probably won't be nearly as strong. I think there's going to be more supply constraint problems that could lead to spottier improvements in cloud guidance and outlooks for next year. So this time, I think like last time, what I would say is the stocks that are going to be big earnings beneficiaries are likely to be companies that triple beat. That means they beat expectations on earnings, they beat expectations on revenues, and they beat expectations on guidance. Guidance is the one that I'm more worried about here because of all these supply constraint problems that are starting to get more acute as time goes on. So positive market reactions to triple beats, those are stocks that are much safer to own and hold, where you can expect follow through. Absent that, I would be more concerned. So I would be cautious of a rise in flat to negative market reactions to beat. So you have stocks that beat on 2 or 3 of these and they don't react positive. That means investor sentiment is getting skewed towards negative and something to be concerned about in that stock and in the market if we get more of those. Okay, we're probably going to get a little bit more information on tapering from the Fed meeting minutes out Wednesday. And of course, we have PPI and CPI out later this week. That'll also give some flavor to what the Fed may do at its early November meeting that I think is the key thing that the market is going to be looking for. All right, so we've talked about the secular bull market in commodities, how we expected to gain relative strength, how energy tried to sort of take the baton from base metals in that, and really they kind of did this month. Energy, we can see that crude oil broke above this key 77, 2018 and 2011 highs, really important level, and it's broken above, and that really projects to sort of mid-90s to even 110s, 100 area eventually. And so we like oil plays. Oil's a bit extended. If you haven't already gotten into plays directly, I think there are some stocks you could buy that are going to participate in that move. And these would be things that I think you can still nibble on even in this correction. Financials and energies are probably the only area where I would say that. You want to be really conservative. I like TPYP, which is pipelines. It has income, 4.5% yield as an energy play with a 20.6 open protective stop. You want to be more aggressive. I like looking at our list for E&P and energy-related things that break out. Matador is one that's broken out recently, had a very nice breakout. This is to new all-time highs. It's a triple-digit earnings grower, and it retested the breakout point, which was a pattern in itself, and then broke higher. You can still get in with relatively decent risk to reward, so I like that. But what I would do is I'd be playing these things with about half or a third of normal allocation. And when you get 1R, take half profits so that you have nothing to lose and everything to gain on your retail protective stock so that you get free positions. And I would build those, and that's what I would do until our correction is over.